Thank you for joining us. My name is Jay Tai, a current master's student at Duke Fuqua School of Business, studying business analytics, and I'm here with my mentor, Dr. Azar. He earned his master's and PhD in computer science from Duke as a James B. Duke Fellow, which is Duke's most prestigious graduate award. He specializes in buying shares of pre-IPO unicorns and helping these companies go IPO, and has invested in over 200 startups spanning 25 years, in which 12 of these have already gone public or been acquired. Dr. Azar is also a general partner of Azimuth Opportunity Fund and executive and residence at Duke University's Fuqua School of Business, and has previously served as the managing director of Duke Capital Partners. So he is also an advisor to several funds, and this platform, very exciting, will be used to let people know more about him, about Azimuth, and about venture capital. So Dr. Azar, thank you so much for being with me today.
It's a pleasure to be here.
So for the audience that doesn't know you, can you briefly introduce yourself and how you got into the venture capital world?
I got into it because of the dot-com bubble bursting. And what that did is it made the valuations very low for the startups. Before that, I was an entrepreneur, but then when the valuations dropped, I thought it's going to be better for me to be an investor because companies are cheap. So there's no point raising money. It's actually better to invest money in companies.
Yeah, so I'm guessing that that's when you started investing. Can you give us a specific time when you started doing that?
Sure. So it was about 2001 when this happened, and I became an amateur investor. To be honest, I didn't make much money until 2007. And the main reason was that I wasn't investing professionally. I was basically an amateur investor. And I almost quit in 2007 and didn't really want to do anything, retired. That was also a time that my last startup folded because it was heavily exposed to the financial markets, and the financial markets collapsed. So I was going to retire and live my life happily ever after. But then one of more seasoned investor in Silicon Valley said, "Oh, the reason you haven't made money as an investor is because you're not doing it right." So he took me under his wing, and then I learned from a number of other seasoned venture capitalists as well, and turned the corner around 2008, 2009 when things started going well.
Mm-hmm. Yeah, so that's a very interesting journey of your investing journey. So I know you're also a partner of Azimuth. So would you say that you're an entrepreneur or an investor more? What do you identify as?
That's an identity crisis that I often have because my heart is always an entrepreneurial heart. So I'm always trying new things. But my brain is more from an investing perspective, is that how can we communicate value? How can we monetize that value and so on? So I do both things, even though my primary role is as a venture capitalist. I take a very entrepreneurial approach. In fact, Azimuth was more of an entrepreneurial adventure when it started, as opposed to a venture capital adventure.
Yeah, that's a great answer. And on that note, for Azimuth, can you talk about how you came about this company and what your goal is here? What's the incentive behind finding this company?
So I was, I was sitting and actually just checking my email when one of very well-known GPs called me to ask me for advice. So I advise a few funds in Silicon Valley. And what he said is that we have an unsolicited offer for a company at the previous round's valuation. And do you think we should hold or we should sell? And I asked a few questions and concluded that the value of that company is about twice what it was at the previous round's valuation. So it doesn't make sense to sell. It definitely doesn't make sense to hold. Well, actually, it does make sense to hold at least, but it definitely makes sense to buy more because you're getting about a 50% discount. So I said, well, instead of you selling to this other unsolicited offer, I will buy the shares that you were planning to sell at the same offer that they had made. And that's basically what started the Azimuth journey. It first started as Azar Investment Group, which was an offshoot from my family office, Azar Family Office. where we invested our capital, kind of pooled our resources and invested. But then the opportunities just became so many and so good that I needed to kind of solicit funds from outside, and also made an arrangement with another general partner who is much more experienced investor than I am. He's been doing this, for, well, actually a number of years. It's about the same, but he has just been doing it like full time. That's all he's been doing. Whereas I have taken some time off for some entrepreneurial ventures.
Yeah. I think something that you mentioned at the beginning of my internship with Azimuth is also that one of the incentive is to make pre-IPO VC accessible to everyone. And that's a huge motivation for Azimuth. Can you expand a little bit more on that?
Yeah, so typically to get into venture capital, you need hundreds of thousands, if not millions of dollars as a minimum investment. And that is primarily because nobody wants to deal with the $50,000, $100,000 checks. For many reasons. One reason is that they're just, in order for you to have a sizable fund, you have to have many of these checks. The other reason is that the 50, 100,000 or people who invest small amounts are known to give the most trouble, which means that when the government shuts down and SEC is closed, so IPOs are stalled right now, they are the ones that are going to be calling most frequently and saying, when is the government going to reopen? And we don't know the answer to that. And we basically can't really answer that question. So that's the reason why typically most VCs avoid small investors. Something changed a couple of years ago that my son's friends wanted to join in and invest in VC. And they didn't have the minimum at that time. Our minimum was $250,000, which still is pretty low. But they didn't have $250,000 sitting around. However, they had nice, well-paying tech jobs, still do. And they said, well, we can invest basically about, anywhere from $25,000 to $50,000 per quarter, and we can give you $50,000 right now, which is well below minimum. It would take us like a couple of years to reach the minimum of $250,000 if you would allow us to do that. So basically, we ran an experiment, and this is where the entrepreneurial side of me comes in, is that I'm happy to run an experiment with a small number of people. And that's basically what you did. And we turned out to be like all the myths that are there for small investors are not true. I mean, these are highly educated people. They understand basically what is going on. Not a single one of them called, asked me, when is SEC going to reopen? They just trust us to make the right decision. And that's basically the trust in integrity, the trust and competency are the two main things that a VC relies on, because otherwise, if you don't have either one of those, it is very difficult for anybody to trust you with your money, with their money.
Yeah, and I think Azimuth definitely achieved that and has both of those. And on the point of, expanding the accessibility of venture capital to everyone, for your background, entering this field seems easy, but for most people, it can be a little bit daunting. So what do you tell people who feel that venture capital is a little bit too risky for them?
So, venture capital, in my opinion, at least, it is not as risky as the public markets. And one of the key reasons is that there is a concept of preferred shares. And simply put, what that means is that the investors who have invested cash are going to get their cash back first, which means if a company loses value, the investors are still protected. And that is the key thing that makes venture capital not as risky as people think it is. So for example, if I invest $20 million in a $100 million company, and that company's value is cut in half, I still get my 20 million back dollar for dollar, or 20,000 back dollar for dollar. And that's one key thing. The other key thing is that, like any other investment, if you put all your money in one company, it's a bad idea because that company can do great, but that company can also go out of business. The third thing that we do is that we look for companies that are close to an exit. An exit can be through an IPO, where they are listed on a stock exchange, or it can be an acquisition. So these companies are well established. They typically have revenues in hundreds of millions of dollars. We do not invest in small startups. In fact, I really, really advise people not to invest in the early stage at this time. It is one of the worst times to invest in early stage. the risk is at the highest, and so is the valuation. So generally, when the risk is high, the valuation is low. But it's a very strange time that the valuations and the risk are both very high for early stage investors.
Yeah, and so in your opinion, which companies are your favorite investment targets so far?
I guess I do get a little bit emotional, so it is favorites. Just like I would have favorite colors and stuff. I have favorite companies, but these companies are based. The favorite is based on what impact they're having on people's life. So I have one company that is a financial inclusion company. Most of its business, in fact, almost all of its business is in Mexico, and they lend money to people who are not banked. They don't have bank account, and about 50% of people in Mexico don't have a bank account. So it's a little bit hard to believe that in US, and that company is not suitable for US because most people here have a bank account, they have a credit score, and so on. So they typically extend loans to those people who do not have that, and it is really changing lives in Mexico. The second company is a lighting company that was started by, actually, there are two companies that merged, and what they do is they solve the problem of LED lights being unhealthy. So people who invented LED lights realized that LEDs actually are very unhealthy. They save money, they are very good from energy efficiency perspective, but they can cause anywhere from like cancer to Alzheimer's among older people and ADHD and depression among younger kids.
Yeah, and yeah, those companies sounds great. And for the audience who wants to get into VC and also understand more about Azimuth, can you talk a little bit about how you find such investable companies like the two companies you just mentioned?
So I have been investing for over 20 years myself and have invested in over 200 companies, probably nearing 300. My partner, David Frazee, is a very seasoned investor. So between the two of us, we have over 300 companies, maybe close to 400 companies that we have invested in. And because we are investors in these companies, we have information rights, which investors have. And sometimes we even have board positions or board information rights, which allows us to identify companies that are investable. And typically what we are doing is just increasing our investment in companies that are doing well. This is quite the opposite of what some other VCs are doing. They are actually trying to invest money in their losers, trying to save them. As heartless as it may sound, I think that's not a good idea. In fact, it's better to let them die a quick, painless death as opposed to elongate them and put them on life support and draw out their misery, and let these founders find jobs and so on. So yeah, that's basically our main source of deal flow. The other source is just through our network. We have friends who say, hey, we have this company, and another investor that is invested in this company is a jerk. Can you see if you can buy them out so that we can have like a less toxic environment? So we would get involved in those kinds of situations as well. So in all cases, we are looking for access to the leadership and the investors. We are looking for access to information that is not publicly available. That puts us at an information advantage over others.
Yeah, and when you're selecting these companies, I was just wondering, how do you evaluate these companies and what makes them so investable?
So the valuation for most of these companies is done by, well, there are several methods. The one we use most frequently is called CCA. I think it is comparable company analysis. And what it does is it compares you to companies that are public, where valuations and financials are known, so we can compare them. So for example, Quesky, which is the first company I mentioned, the financial inclusion company, has sales that are in hundreds of millions of dollars. We can then see what ratio those sales are compared to companies like Klarna, SoFi, Affirm, which are in the same space. And because their values are known through the public markets, we can basically compare them. And then we discount the multiple a little bit, because any company that is publicly traded is considered less risky of an investment. So we typically discount that. So in case of Quesky, for example, we discounted its valuation by about one third. So it is 2/3 of what Klarna's valuation would have been with similar numbers.
And thinking on the other perspective now, so thinking in the side of the companies that we're investing, why would these companies want our investment if they don't really need additional funding?
Oh, that's an excellent question. So this is a common thing that I have to explain to most of our investors. The companies don't generally need money. The companies are doing fine. They're not damaged. They can go IPO or be acquired without any additional funding. What is going on is that the investors in those companies are desperate to sell. And the reason they're desperate to sell is that back in 2010s, before COVID and inflation, almost all VC funds were structured so they had a 10 to 12 year life. That means that after 12 years, they have to die. And just like a dying person, they have to either sell their assets or they have to look for a continuation vehicle to give their assets to another fund because that fund is dying. So they are very motivated sellers, and they have investors in those funds who are desperate for cash. So I have, for example, a 76-year-old friend who is, probably has 5 to 10 years to live because of health issues. And I was asking him, why does he want to sell at a discount? And he said, well, I would rather enjoy half the money now than 5 times the money after I'm dead. So that's one kind of thing. There are also family offices where the person who made most of the money has either passed away or is not actively involved in the family office, and the younger generation wants to buy mansions, Lamborghinis, and so on. And when when they call their fund and say, hey, we want our money back, the fund people usually tell them, look, right now you'll have to give about 40 to 50% discount. And they say, BS, that's not happening. You just don't want to return our money now. So there is kind of a lot of pressure on these funds to sell some of their assets, or sometimes a large percentage of those assets, to give cash back to their investors who have been kind of waiting for like 10, 12 years to get money back.
Yeah. And on the note of discounts, I know you also mentioned previously, you get like 40 to 50% or even 2/3 of discounts on these pre-IPO companies. Just wondering, why would any seller give you such a huge discount? You kind of touched on that earlier, but kind of want to dive deeper into that.
Yes. So essentially what's happening here is that the sellers, it's a buyer's market. So there are a number of sellers that want to sell their shares, but they can't find enough buyers. So buyers can command a very good price as a result. And that's really essentially, what's happening. It is kind of like, buying candy the day after Halloween. So, Halloween is tomorrow. If I want to buy some candy for myself, I'm not going to buy it today or tomorrow. I'm going to buy it on November 1st. And then I will get something like 50% off because there are many more buyers. Then there are many more sellers than buyers, so I can get a much better price. So it is simply a supply-demand, simple economics where buyers right now can negotiate values very easily. It's kind of the opposite of how cars have been after COVID. Car prices have gone up. Even though cars generally depreciate in value, some cars prices are going up because there are more buyers in the market than sellers. So there are more buyers in the market than sellers, so the sellers can ask for more. So it is a simple kind of supply-demand issue.
Yeah. So on the note of investment and also your extensive experience in investing, I also want to kind of gauge what is the typical size and structure of your investments.
So typically, in order for us to get a good price on any of the names that we want to buy, we have to buy 5 to 10 million at least. So that's usually the lower end of things. And the maximum that we have gone to is about 30 million, because after that, it is very difficult for us to it's difficult for us to finance that kind of thing, and without losing diversification. So diversification is kind of an important investment principle in almost all situations. And that's the main reason that we don't try to go over 30 million. And the only reason that we go up to that is that most of our money comes from like big checks and family offices and high net worth people who are writing checks, large checks. So for example, we have an investor that we are discussing right now who wants to invest $30 million. So for them, if you have like bits and pieces of 5 million, it's not going to work. And I know these are big numbers, and these are big numbers, by the way, for me as well. But coming back to like the question you asked earlier, I would rather make that $50,000, $100,000 investor a lot of money, because that would change their lives. For people who are already billionaires, it's not, whatever I'm doing is not going to have much of an impact on their lives. Their lives are not going to get any better. Probably the net worth can be measured in a fraction of Elon Musk's net worth. They're maybe 1,000th or 100th of their net worth. So it's not going to, if I make them even a few $1 million or tens of millions of dollars or even $100 million, it's not going to change their lives. But if I can get the $50,000 investor, quadruple their money in a few years, that's going to change things.
Yeah, that's a great mindset to have. And I'm thinking that, that's a green flag for sure. So this question is more so very straightforward. Just wondering, why wouldn't someone want to invest with you?
So there are three reasons why people would not want to invest. First, they don't trust my integrity. And I think that if that is not the case, they shouldn't really be wasting time, and I should, or their time or my time with them. And the second is that they don't trust my competence. There is kind of like, especially people who are very, very good at in their field, there is this, they think that they can go to another field and achieve the same kind of results. So for example, pro athletes may think, hey, because they won the Super Bowl or they won the NBA championship and they have 5 rings, and I'm exaggerating to make a point. I mean, doctors have the same issue at times. No offense against doctors. And a lot of programmers have a lot of ego. So they think, well, they can do the same thing, and why they should work with me, because they would rather just go direct with the company. So that's the second thing. And the third thing is that people generally want to know where their money is going and have control of their money. So it's not so much their reliance or their ego, but it is more like the controlling nature of a human being. And we actually address the third part. We allow them to pick and choose and weight their investments. We give them very thorough reports in terms of what are the risk factors and why they should or should not invest in a particular company.
Yeah, and on the note of risk factors, can you expand a little bit on what reputational risk do you consider when facilitating a pre-IPO sales?
So reputational risk, as in the risk of my reputation or the company's reputation? Whose reputation?
It can be both sides, but I was kind of referring to the companies that we're looking to invest. Yeah.
So as far as the companies that we are looking to invest, the main risk, well, first of all, this is venture investment, this is equity investment, and anything can go wrong. Just like, in a public company, like, Google did really great in their earnings report, their stock soared. Microsoft and Facebook didn't, their stock went down. These things can happen. And, there are companies that I was looking at, one company called, I think LRN is their ticker. They lost 50% of their value in a day. So anything can happen with whenever you are like investing in companies. So we generally try to, and this is kind of from our reputation perspective, the only thing that venture capitalists have is their reputation. If we don't have a reputation, we might as well like go do something else, men's shoes or something like that. It's not, going to work out. So we take a lot of extra care and let probably about, I would say, 20 to 40 investments go before we invest in one company. So we reduce the chance of our failure as a result. The company itself, when it is going IPO, it is essentially a very, very detailed audit process that they have to go through. And for them to be IPO ready, we basically have a number of meetings with them. And that's actually more of my partner's work, where we just make sure that, their books are in order, their, everything that they are doing, it's tracked very well. Because there's, in fact, I teach fraud analytics, and I know you're in that class, that there's a lot of financial fraud that takes place. There was a company, for example, a couple of years ago, I shouldn't mention the name, but let's say that company is XYZ, they had all these users that they had manufactured and reporting and so on, and these users were just bots. Actually, there is a public case that Charlie Jarvis, I believe, sold her company to JP Morgan, and she had a number of customers, but most of these customers were fake. And she's now, I think, serving in some kind of a criminal sentence in addition to civil penalties. So these are kinds of things that we have to really dig deep, and it's almost like, doing a full body cavity search. And by the way, as VC firms also, when we start accepting retirement funds, the level of audit, and when we start listing publicly, it's the same thing.
Yeah, what you established here sounds very incredible. Can you share some insights into your current investment target for the audience, for investors out there? What are some current opportunities that we have for them to invest in? You mentioned Kiski earlier. Can you expand a little bit on that?
Yeah, so if, this is only, first of all, we don't do general solicitation, and only accredited investors can invest with us, which means that they have to have a certain income or net worth level. And this is not, what I'm sharing the two companies that we are focused on right now just for educational purposes. I'm not soliciting investment on the show for them. But one company is a company that is valued over $2 billion right now. And we have access to their shares at about half, a little bit over half the price for them, which effectively means that, the day that we acquire shares, or our investor acquires shares, the next day they wake up almost doubling their money. And then we are also looking for a growth, and this company is growing at about 50% year over year, which basically gives us a very healthy margin. We are expecting this company would go IPO sometime next year, which essentially is how we get to doubling the money in 1 year. The other company, Khoros, is a smaller company. Again, we are acquiring their shares at about half price, and it's going to take them about 3 years to go public. But the upward potential is much higher over these 3 years. That they can give a huge multiple in return, whereas Quesky, we are looking to about double the money. With Khoros, we are looking to quadruple or quintuple our investment there. So generally, the longer period that we would invest, we have to have a higher return for those companies.
Yeah, and being conscious of the time, I just want to open the floor to Professor. Do you have anything else that you want to share with us today?
If you want to learn more about this, I love talking about this. Really would be interested in, talking to anybody that is interested. Feel free to reach out to me at any time. I am going to show, my email address is on the screen right now, salman@azimutopportunity.com. Just feel free to send me an email if you have any questions, if anything wasn't clear. And, there are other topics and stuff that we can definitely talk about, and happy to do that also at a later time.
Yeah. Thank you so much for being with us today.
It was my pleasure.
Yeah, I learned so much. Bye.
Take care. Bye-bye.